So in this session now, we're going to deal with the treatment of taxation and working capital in NPV computations. So as the case is with other business profits that you make, the profits that you generate only from investment projects will be subjected to corporation tax. So if your NPV analysis is going to be correct, you must think about how you're going to bring in tax. So now we're going to talk about the treatment of taxation in your NPV computations. And later on, we also look at the issue of working capital. So in the approach that we're going to use ourselves, taxation will give rise to two additional cash flows in our NPV analysis. What is that? Well, the tax that is payable on the net project cash flows will be treated as a cash outflow. So net project cash flows refers to cash flows that remain when we take our sales revenues and deduct all relevant costs. And what remains is your net cash outflow. And we will calculate the tax that is payable on that amount and it will come in as a cash outflow. In our NPV analysis, we don't include depreciation because it's a non-cash flow item. And you also know from your tax studies that when the tax man comes and he looks at your financial performance, he does not really accept the accounting depreciation as an allowable expenditure. However, what they will do is they're going to give you a relief in recognition of the fact that you bought an asset, and that relief is called capital allowance. So the capital allowance is deductible from your profits so that you arrive at a taxable cash flow or taxable profits. So in our analysis then, we're going to take the tax that is saved on the relief called capital allowance, or the other term which uses tax allowed depreciation. So the tax that is saved by the capital allowance or tax allowed depreciation will capture it as a cash inflow. So what are you going to do in your questions then? Well, when you're dealing with a question and you see taxation, here's what you look out for. Look for the tax rate. Secondly, look at the timing of tax payment. There are two possibilities. It's either tax is paid in the same year as the cash flow generation, or is paid in arrears in the following year. So all you do is look at what the question says. Thirdly, you also look at the policy for the computation of capital allowances. There are two possibilities. It's either use reducing balance to estimate your capital allowances or use a straight line method. So you must be able to identify the policy that is being used and apply it correctly. So therefore, here are the two lines that I was talking about in the typical NPV computation. Then you've got two lines that we are going to use ourselves. Treatment of taxation. So we're going to have tax payable, okay, on these net cash flows. So in this particular situation, we're saying these are one net cash flows, and we're paying tax at 30%, and these become the cash outflows. And also we got tax saved on the capital allowances, which will come in as a cash inflow. As you can see, these figures are positives. So the approach that we're going to use is the approach where we'll have two lines. One, cash outflow representing tax payment on these figures. And secondly, a cash inflow representing tax saved on the capital allowances. And we'll see this as we proceed with our questions. Let us now come to the next item. The next item is what are working capital? Now, we have covered working capital before in class and realized that working capital is necessary to support our business operations. These are funds that we need to support our daily operations. So when you got a project, then reasonably, we must raise a question. What are the working capital requirement? Will there be working capital needed for the project? And if you're going to be very realistic, certainly you need working capital to finance or support your project. So supposing we are given a question that there is working capital, how are we going to treat it? Well, three possibilities. Number one, the initial amount of money that is invested in working capital is treated as a cash outflow. So that amount normally is placed in year zero. Before you can trade, you can generate revenue for year one, that money must be in place, so we'll treat that as a cash outflow. And this initial amount is normally placed against year zero as a cash flow. In the subsequent years, only the increase over and above the initial amount will be captured as a cash outflow. And should there be any decrease, that will be captured as a cash inflow. Well, at the end of the project, in the final year, unless there is any other assumptions, but in the absence of any assumptions, what normally do is the full amount invested in working capital is recovered as a cash inflow at the end of the project. So what we're going to do now is we're going to look at a question, an illustrative question, so that we can see these 3 points in a question. So we've got a company here. This company needs working capital, which is equivalent to 10% of sales revenue to support the operations. We're given the sales revenues there for 5 years. And what we're told is that working capital is 10% of this amount. The question is, demonstrate the working capital cash flows to be included in the NPV computation. So when you come to your NPV, that line for working capital, what figures are you going to put there? What cash flows are you going to put there? This is what the question is all about. And these are the figures that you're going to put there. So as we can see, our sales there are indicated. Those are our sales. And we're told that the working capital needed to support these sales is 10%. So 10% of the figures is here. Now, after we've identified working capital required, we come now to investment appraisal. What are figures are going to put there? Here's the figures. This 120 will be placed as a cash flow requirement, working capital cash flow requirement in year 0. So in year 0, before we can trade, we have got 120 that we spent. In the subsequent year, as you can see, we don't put in 150. We don't. It's just an increase over and above this initial amount. In other words, there's 120 amount which is still going around your business. So you simply do a top up, and the top up is the difference. That is why we have a 30 here. Again, between these 2 years, we just need a top up, an increase from 150 to 180, which is a 30. That's what you put here. Now, here's what happens between year 3 and 4. The working capital requirement has dropped from 180 to 160. This drop is recovered, is considered as a cash inflow. So we've recovered 120 from 180 to 160, and that is a 20 there. Then look at what is happening again. Our working capital requirements have shot up again to 190. So the increase from there to there, which is a 30, is treated as a cash outflow against year 4. And in year 5, now at the end of the project, what happens? The full amount, all the amount that is sitting in the project, all these amounts here, the cash outflow plus the cash outflow plus cash outflow, less the recovery, plus another cash outflow, the 190, this amount is recovered as a project cash inflow when at the end of the project, unless there are other assumptions that have been given. And as we practice exam questions, we'll see other possible assumptions that could be given. So next, what we're going to do now, we're going to look at the bigger question. We're going to see the treatment of inflation, taxation, and working capital. For now, go through your notes.